How the new 14% tax rate saves you $840 this year. CRA secret. Something changed at the Canada Revenue Agency this year, not with a press conference, not with a major announcement, but quietly, in the way tax brackets and pension income are now being handled for a specific group of Canadians. And if you're receiving retirement income right now, or you're planning to in the next 12 months, this affects you. We're talking about a shift in how certain pension withdrawals are taxed at the federal level. A shift that could mean an extra $840 staying in your account this year instead of going to Ottawa. But here's what concerns me. Most retirees don't even know this exists yet. My name is Joseph, and I've spent over 2 decades analyzing Canadian retirement policy, CRA updates, and pension strategies. Today, I'm walking you through what's happening, who qualifies, why the CRA made this change now, and exactly what you need to do to make sure you're not leaving money on the table, because this isn't automatic for everyone. Let's start with where this came from. For years, Canadian tax policy around retirement income has been relatively predictable. You contribute to your RRSP during your working years. You pay into CPP. Maybe you have a workplace pension. And when you retire, you start drawing that income down, and you pay tax on it. The federal tax system uses what's called a marginal tax rate structure. The more you earn, the higher percentage you pay on each additional dollar. That's been the foundation for decades. But in late 2024, something shifted. Pension policy analysts started noticing references in CRA technical bulletins to what they were calling an eligible pension income adjustment. It wasn't widely reported, it didn't make headlines, but it was there, embedded in updated tax treatment guidelines for certain types of registered retirement income. By early 2025, tax professionals and financial planners who work closely with retirees began connecting the dots. A new effective tax rate, 14%, was being applied to a specific threshold of pension income for Canadians over the age of 65 under very particular circumstances. Now, let me be clear. This is not a universal tax cut. It's not a blanket benefit. It's a narrowly designed relief mechanism that applies to eligible pension income within a certain income band, and only if you meet the criteria. Here's why this matters right now. Canada is facing unprecedented pressure on its retirement system. We have the largest cohort of retirees in our history. CPP and OAS expenditures are climbing. Inflation has eroded purchasing power for fixed-income seniors, and the federal government is under enormous fiscal strain. At the same time, there's been growing concern, voiced by groups like CARP, the National Institute on Aging, and provincial finance ministers, that middle-income retirees are being squeezed. They earn too much to qualify for GIS, but they don't have enough to comfortably weather rising costs. This 14% rate appears to be a response to that pressure, a quiet attempt to provide some relief without triggering a major fiscal commitment or public expectation of broader cuts, but it's conditional, and it's temporary, at least for now. So what is this 14% tax rate, and how does it actually work? Here's the technical foundation. Under the updated CRA guidelines, eligible pension income, which includes RRIF withdrawals, LIF payments, and certain annuity income for Canadians aged 65 and older, can now be taxed at an effective federal rate of 14% on amounts between $30,000 and $55,000 in total annual income. Let me break that down. If your total taxable income from all sources, CPP, OAS, pension withdrawals, investment income, falls within that range, the portion coming from eligible pension sources is taxed federally at 14%, rather than the standard marginal rate, which would typically be 20.5% in that bracket. That's a 6.5 percentage point reduction. Now, this only applies to the federal portion of your tax. Provincial taxes still apply separately, and those rates vary depending on where you live. But federally, that difference is significant. Let's use a real example. Say you're 68 years old. You receive $15,000 a year from CPP and $8,000 from OAS. That's $23,000. You also withdraw $20,000 from your RRIF to cover living expenses. Your total income is $43,000. Under the old system, that $20,000 RRIF withdrawal would be taxed federally at 20.5%. That's $4,100 in federal tax on that portion alone. Under this new structure, if you qualify, that same $20,000 is taxed at 14%. That's $2,800. You just saved $2,300 federally on that one income stream. Now, depending on your exact situation, how much you withdraw, what other income you have, and whether you're splitting pension income with a spouse, your personal savings could range anywhere from $400 to over $1,200 annually. The CRA's modeling suggests the average benefit for those who qualify sits around $840 per year. That's not life-changing. But for someone on a fixed income, that's 2 months of groceries. That's a property tax bill. That's breathing room. So who actually qualifies for this? This is where it gets specific, and where a lot of Canadians might assume they're included when they're not, or assume they're excluded when they actually do qualify. First, you must be 65 or older. This does not apply to early retirees under 65, even if you're drawing pension income. Second, your total taxable income must fall between $30,000 and $55,000 annually. If you're below $30,000, you're likely already paying minimal federal tax, so this doesn't help much. If you're above $55,000, you're outside the target zone, and standard marginal rates apply. Third, the income being taxed at 14% must be eligible pension income. That means RRIF withdrawals, life income fund, LEF payments, eligible annuity income from a registered plan, certain employer pension payments if you're over 65. It does not include CPP or OAS payments, non-registered investment income, employment income, TFSA withdrawals, which aren't taxed anyway. Fourth, and this is critical, you need to indicate eligibility when you file your tax return. The CRA is not automatically applying this for everyone. You or your accountant must identify the income type and apply the correct treatment. If you don't, you'll be taxed at the standard rate, and you'll miss out. Now, let's talk about who this is really designed for. This targets middle-income retirees, people who worked, saved, built up an RRSP or pension, but aren't wealthy. Canadians who are just above the threshold for GIS, but well below the income levels where tax planning and income splitting become major advantages. It's aimed at the forgotten middle, the group that pension advocates have been warning about for years. Let's get concrete about the financial impact. If you're a single retiree with $42,000 in total annual income, $18,000 from CPP and OAS combined, and $24,000 from your RRIF, you could save approximately $900 federally under this structure. If you're a couple, and both of you are over 65, and you're pension splitting that RRIF income, the combined household benefit could approach $1,400 to $2,600, depending on how the income is divided. But here's what you need to understand. This is not cumulative year over year in terms of growing value. It's an annual savings that applies as long as the policy remains in place and as long as you stay within the income threshold. That means if your income rises, say you start taking more from your RRIF, or you begin receiving additional pension income, you could move out of eligibility. Conversely, if your income drops due to reduced withdrawals or changes in CPP indexing, you might find yourself benefiting more or benefiting for the first time. The real value here is in cash flow stability. For retirees on fixed income, $840 extra per year means approximately $70 per month. That can offset prescription costs not covered by provincial plans, property tax increases, utility bills during winter months, inflation-driven grocery price hikes. It's not transformational, but it is tangible. And in retirement, every dollar of predictable relief matters. Now let's talk about why this is happening. The federal government is under immense fiscal pressure. Deficits are high. Debt servicing costs are rising. There are competing demands across healthcare, defense, climate policy, and social programs. At the same time, Canada's aging population is putting unprecedented strain on the retirement system. OAS costs alone are projected to exceed $80 billion annually within the next decade. CPP remains actuarially sound, but political pressure to expand benefits continues. In this environment, the government needs to do two things simultaneously: control costs and maintain political support among seniors, one of the most politically engaged demographics in the country. A narrowly targeted tax adjustment like this accomplishes both. It provides visible relief to a sympathetic group, middle-income retirees, without the fiscal cost of a broad-based tax cut. It doesn't increase program spending. It doesn't expand entitlements. It simply reduces the tax take on a specific slice of income for a specific group. Politically, it's defensible. Fiscally, it's containable. But it also reflects a broader shift in how Ottawa is thinking about retirement policy. Rather than expanding universal programs like OAS or CPP, we're seeing more targeted, means-tested, or income-adjusted interventions. The goal is precision: help those who need it most, limit costs, and avoid creating new long-term obligations. This is consistent with other recent changes: the OAS clawback threshold, the GIS earnings exemption, the pension income splitting rules. The government is trying to manage a retirement system that was designed for a different demographic reality, and they're doing it quietly, incrementally, and with minimal public debate. That should concern you, not because the relief isn't real, but because it signals a larger trend toward conditional, targeted benefits that require you to stay informed and take action to access. So, how are experts responding? The reaction has been mixed, but largely cautious. Tax professionals and financial planners have welcomed the relief, but many are frustrated by the lack of clear public communication. Several CFPs I've spoken with noted that their clients had no idea this existed until it was brought up during tax planning sessions. CARP, Canada's largest advocacy organization for older Canadians, issued a statement acknowledging the measure, but calling for broader, more transparent reforms to retirement income security. They've pointed out that $840 a year, while helpful, does not address the structural challenges facing retirees: inflation, healthcare costs, housing affordability, and inadequate workplace pension coverage. The Canadian Centre for Policy Alternatives has raised concerns about equity. They argue that middle-income retirees are being given modest relief, while low-income seniors, who depend entirely on GIS and OAS, are still struggling with program access issues, clawbacks, and administrative delays. Provincial responses have been more muted. Some provinces, like British Columbia and Quebec, have their own senior tax credits and pension income measures, which may interact with this federal change in complex ways. Retirees in those provinces need to understand how both systems work together. What's notable is the absence of significant media coverage. This hasn't been a front-page story. It hasn't been debated in Parliament. It's a technical adjustment, implemented through CRA guidelines, with minimal public visibility. And that's exactly the point. This is policy by stealth. It's effective, it's targeted, but it requires you to be informed, proactive, and engaged with your own tax situation. So what do you need to do? First, determine if you qualify. Look at your total taxable income from all sources for 2025. If it's between $30,000 and $55,000, and you're 65 or older, and you're receiving eligible pension income, you likely qualify. Second, talk to your accountant or tax preparer before you file. Make sure they're aware of this provision. Not all tax software automatically applies it. Not all preparers are up to date. You need to confirm that your eligible pension income is being coded correctly, and that the 14% federal rate is being applied. If you use commercial tax software, check the CRA's updated guidelines and ensure your RRIF or LIF income is categorized as eligible pension income under the new structure. Third, consider your withdrawal strategy. If you're close to the $55,000 threshold, think carefully about how much you withdraw from your RRIF this year. Taking out too much could push you over the limit and cost you the benefit. Conversely, if you're just under $30,000, a modest increase in withdrawals might position you to benefit. This is where income planning becomes critical. Fourth, if you're married or in a common law relationship, review pension income splitting. If both of you are over 65, splitting eligible pension income can optimize your tax situation and potentially double your household benefit from this measure. Fifth, keep records. If the CRA questions your return or requests documentation, you need to be able to show that your income sources qualify and that the treatment was applied correctly. Sixth, stay informed about policy changes. This measure is currently in place for the 2025 tax year. There is no guarantee it will continue beyond that. Federal budgets, political changes, and fiscal pressures could all affect whether this becomes permanent, is modified, or is quietly removed. Watch for updates from the CRA, follow trusted Canadian financial and retirement policy sources, and don't assume this will always be there. Looking ahead, what can we expect? In the short term, I expect this measure to remain in place through 2025 and likely into 2026. It's politically palatable, fiscally modest, and serves a strategic purpose for the government. But medium to long term, the trajectory is less certain. If inflation moderates and fiscal conditions improve, we might see this expanded, either by raising the income threshold or lowering the tax rate further. If deficits worsen or political priorities shift, this could be scaled back, narrowed, or eliminated entirely. What's more likely, in my view, is that this becomes part of a broader pattern. More targeted, conditional benefits that require retirees to actively manage their tax and income strategies. The days of simple, universal programs with automatic eligibility are fading. The future of Canadian retirement policy is complexity, means testing, and self-advocacy. That places a burden on you, the retiree, to stay informed, ask questions, and work with professionals who understand the system. It also underscores the importance of financial literacy in retirement. Knowing how CPP, OAS, GIS, RRIF rules, and tax policy interact is no longer optional. It's essential. Here's what I want you to take away from this. The new 14% federal tax rate on eligible pension income is real. It can save you approximately $840 this year if you qualify. But it is not automatic. It is not widely known, and it requires you to take action. This is a snapshot of where Canadian retirement policy is heading. More targeted, more conditional, more dependent on your ability to navigate the system. If you're between 65 and 75, if you're drawing from an RRIF or receiving pension income, and if your total income sits in that $30,000 to $55,000 range, this matters to you right now. Talk to your accountant, review your income sources, file correctly, and don't assume the CRA will do this for you. Beyond that, stay engaged. Watch for budget updates. Follow CRA announcements. Understand how changes to CPP, OAS, and tax policy affect your retirement security. Because the reality is this: the government is managing a retirement system under stress, and the tools they're using are increasingly subtle, complex, and conditional. Your job is to stay informed, ask the right questions, and make sure you're not leaving money or security on the table. If this video helped you understand what's happening, please subscribe. Share this with other retirees, friends, or family members who need to know. And leave a comment below if you have questions or if you've already encountered this in your own tax situation. My name is Joseph. Thank you for watching, and I'll see you in the next one.